Good evening, everybody, and welcome to tonight's special Family Daycare Tax webinar for 2024. My name is Matt Asmanis. I'm the Marketing and Events Manager at Family Daycare Australia. Before we begin tonight, I would like to acknowledge the traditional custodians of the lands that we are all meeting on tonight and pay my respects to elders past, present, and emerging. Thank you to everyone who has joined us to watch tonight, and I'm sure that many of you who are watching have already joined us this year for our online engagement series episodes. Also, a big thank you to everyone who sent in questions in advance for tonight's webinar. There are a huge amount of questions that came in, and where possible, we've tried to merge questions and combine them to ensure that all the main themes that were outlined in the questions are covered. At the end of tonight's session, we will have a live Q&A section. However, this will be time permitting, so I do apologise in advance if we aren't able to take live questions. As you all know, tonight is a special Family Daycare Tax webinar, and without any further delay, I would like to introduce our guest for this evening, who has over 20 years of experience in assisting family daycare educators with their tax needs. He's the Principal Accountant and Director of FDC Tax. Please welcome Ben Mueller.
Yes, hi everybody.
Before we begin, Ben, would you like to share a little bit about yourself and your background in assisting family daycare educators with their tax needs, and also your company, FDC Tax?
Yep. So basically I started, and if you open that first slide, that gives a little bit of just a bit of a background there, that we are a specialised family daycare tax service. While we do other businesses as well as individuals, we actually have a particular specialisation with family daycare, and they're the majority of our clients. So we like to think that we understand the way things work with educators and be able to provide you with the information you need. As it says, and I feel a bit too old when I think I've been going for 20 years with family daycare, but yeah, it's been a great journey. I certainly love talking to all the educators, and yeah, really just good, genuine people that I love speaking to, and I enjoy working with everybody.
Fantastic.
So yeah, look, I hope tonight can be a good informative, and I'll try and make it as interesting and as helpful as possible.
Wonderful. Well, I guess before we start tonight, I just wanted to make an important note for everyone that we're not supplying financial advice tonight during the webinar, and everyone watching should certainly speak to a financial planner or professional about your individual circumstances before making any financial decisions. But without any further delays, let's get started. And Ben, if you'd like to take us through your first topic tonight, which is a 2024 Family Daycare Tax update.
Yep. So look, basically, probably the most relevant things for family daycare educators is the actual 67 cents an hour for running costs. We did cover that to a certain extent last year, but the ATO has actually provided more specific guidance on that, and we're just going to go over a few points that are relevant. Wanted just to speak a little bit about the tax cuts and actually what they mean, or try to put some sort of dollar value to make sense to everybody. And then always an important topic there is the $20,000 instant asset write-off, because everyone's thinking end of year, might be thinking of some larger equipment to purchase or some bigger items, maybe even a car. And we're just going to go quickly over the rules around that, so you can help make a decision there. So in relation to the 67 cents an hour, it relates to the running costs, and there's different running costs that you have that are that you only incur because you're operating your family daycare business from your house, and that's a list of some of them there. But as we go to the next slide, there was different ways that we could claim this in the past. We had like a 52 cents an hour method to claim just your electricity and your energy running costs. And then we could use a diary to claim your other costs, such as your home phone and internet and that sort of thing. The ATO during COVID times, they actually changed it a little bit and allowed it for 80 cents an hour. But now currently they changed that rate down to 67 cents per hour. And basically it's a single rate to try and simplify things when claiming your electricity and your home phone and your internet and those costs. Basically they estimate the cost of all those to be 67 cents an hour. So if you don't want to keep a diary or you just want to keep things fairly simple, I mean, you do need to keep a time diary, which we'll cover, but for those costs, it's actually a simple way to calculate. But it doesn't always work out the highest claim using that, and they do allow you can work it out on actual costs, but you either have the choice of working it out at 67 cents an hour, or you have to go through all your expenses and work out your percentages. So yeah, just moving to the next slide there, where we are looking at. Do you want us to move to the next slide there? So one thing with this, just go back one. So basically, what's important here is that in order to claim the 67 cents per hour method, you don't have to have any kind of separate or exclusive area of your home. Whereas previously under the previous method, you had to kind of have it separate, but now they just allow. So basically all educators are fine no matter how they use their home in order to use this method. And just I think the next slide there. But in order to use it and to work out the number of hours worked, you actually have to have a diary. Previously, we could do an estimate. You would just say, look, okay, I work 8 to 5 every day for 4 days a week, and then I might work a few hours like for preparation before and after, and we could do a bit of an estimate there and work out at the rate. Now, they've made this quite strict in that you actually have to have a record of the number of hours that you worked. Now, with educators, you're fortunate in that you do have timesheets that you submit and you're paid for based upon those. So you can actually get like an hour's worked report, or through what you've worked, that's actually sufficient record. So if you haven't kept a record during the year, if you've been submitting your timesheets, then you'll have a record available. Now, okay, so that's basically the 67 cents per hour. Now, with this slide, actually it has to do with the $20,000 instant asset write-off, which a lot of people would be familiar with purchasing a car or a large piece of equipment. Last year, year ending 2023, they actually had an unlimited limit. So if you purchased a $50,000, $60,000 car, you could claim the full $50,000 or $60,000. Now this year, they've capped that at $20,000. So if you purchase a car less than $20,000, you can get an instant write-off there. But if you purchased a car for, say, $50,000, you still get a claim, but it needs to be claimed over a number of years. So for a $50,000 car, you would get, and if it was 100% business, of course, you would get 15% of that as a claim this year, so $7,500 in depreciation, and then it would increase to 30%. So generally, it's claimable over 3 years. Now, the point of that slide there in the left and the right is that in making a decision to purchase a larger item, you need to be mindful of how much you're actually are earning and whether you even have any tax to pay. So the example on the left talks about if your income is $40,000 and you decide, yes, I'm going to purchase something for $20,000, it shows that there is a saving of roughly about $4,000 in tax if you do that. But sometimes on the right, you've got a lower taxable income, and let's say it's $20,000, and then you go and you can see that tax on $20,000 after rebates is actually zero. So if you then go and spend $20,000, you've saved absolutely no tax. So it's important, if you'll get better value out of it, the more that you spend. And so, look, you should be speaking to your accountant before you go and make a major purchase, thinking that you're going to be saving tax there. And so I hope that makes sense, and we'll just continue on to the next one there. And this kind of goes along with what I was saying with end of year considerations, not only in relation to the assets, but basically what you need to do at the end of the year is think about, well, gee, is my income going to be higher this year, or am I expected to earn more income next year, or more or less? Now, if you expect your income to be higher this year, then you might look to see what expenses you could pay to kind of bring your income down this year. Or if you think your income is going to be high next year, then maybe just hold off paying a few expenses until 1 July. And just going back to the previous point, in that, we don't want to spend money just to save tax, because you're going to spend things on you don't need. So it's effectively a bit of a waste. But in relation to the end of the year, you should think about those expenses you would be incurring in any case, regardless of that. So, for example, maybe you could pay an extra month or two's rent this year in order to bring your income down this year. Or maybe if you've got car rego coming up, pay it a bit early. Or vice versa, if you need more deductions next year, just hold off and pay those next month. So it's just thinking about how much income you're earning and whether you're going to be earning more or less, determining which year you pay it out of. So that's just something to be mindful of. Now, next thing that just wanted to cover there, and I know we're going through quickly, but we want to make sure we cover as much as possible. It's the tax cuts. Everyone's heard about the tax cuts, and look, there's a table there, and it shows the difference and I mean, I've highlighted, there's a change from 19% to 16% there. There's also a small change from 32 to 30%. And there's a bit of a change as to when those different rates kick in there. So the beauty of it is that the majority of people are in the 18 to 20 to 45,000 bracket. Everyone's usually within that, whether you're a high or a low income earner. So therefore, there's quite a good saving there for low income earners, which wasn't available before. But as I mentioned, what does that exactly mean? And if we go to the next slide, I've just put together, like with income, if you just what the savings roughly are that you'll have on a per annum basis as a result of the tax cuts. So if you're earning $50,000, you'll end up with about another $900 in your pocket over the year. And if your income's about $80,000, it's about $1679 that is there. Now, unfortunately, it's the tax cuts. They kick in on 1 July this year. So as for the tax year that we're ending now, ending 30 June 2024, we're not going to see really any benefit until the new financial year. And when we lodge your 2025 tax return. So it's still a year away. But as I've said at the bottom there, you may be able to bring forward some of those savings and realise some of those if you pay quarterly pay-as-you-go instalments, you could potentially look to vary that to bring your quarterly instalments down a little bit. And if you go 2 slides ahead there, Matt, you can see that if you earn $50,000, you can potentially bring your quarterly instalments down by $230. And then if you're earning $80,000, then it's $420. Now, basically the way to understand that is if you think of you know roughly what your income was last year, your taxable income, and you know what your instalments are. If you just take those amounts that are shown there off your quarterly instalments, you'll know that what the saving is and how much your instalments will go down by. But also at the bottom, those will not automatically apply. So if you want to, you can either continue to pay the ATO normal instalments, and maybe that's what you want to do because there's a little bit more that you're paying them, and maybe at the end of the year you could get a little slightly higher refund and just continue along that way. But if money is tight, as it is for everybody, and there's a little bit of savings there that you can take advantage of during the year, but it won't actually kick in properly until next year. For those who have employee family members, the way it works for employees is that the take-home pay that you have, so if your gross was $1,000, is $1,000 at the moment, and you have $100 that's withheld, so your take-home pay is $900. That might change so that instead your take-home pay might be $920 because they change that slightly because you're paying a little bit less tax. So employees are going to realise it a little bit sooner automatically, but educators can do that, but it does require, if you need an accountant to change it or you vary that on your activity statement, you can do that yourself. So they're the main things by way of kind of the tax cuts, as well as a bit of an update there.
Fantastic.
Now, I'm not sure if you want to go to the questions first or whether you want me to head on to. So just.
I think if you like, we'll head on to the next topic. So I guess the next topic is one.
So
that was very,
just go 2 slides ahead there.
Yeah. Sorry.
Yeah. That was, yeah. So the next topic that we had was how much should we be saving for tax, which is it's a very common question because everyone's like it's a bit confusing because you have the tax withholding calculator on the web, and some people use that, but it really is more designed for employees who don't have much by way of deductions. Where if you put your total income, it's going to give you a higher tax rate than what you'd pay because, as in the example, you might earn $100,000, but you've got $30,000 of expenses. Now, you don't want to be paying tax as if you're earning the full $100,000. You only want to be paying tax as if you get on the $70,000. So that's where the withholding calculator, while look, it is good because you'll be saving more than what's required. So that's a good thing. But having a bit of extra cash during the year is good also. So basically, as a rule of thumb, and I'll show just a table of kind of what it means. Generally, about 10 to 15% of what you earn, as a rule of thumb, you should be putting aside and saving for tax. Now, I've broken that down on this table to kind of, if you think of your weekly fees that you receive from your scheme parents, if you add them up, if you're earning between like $0 to $500 a week, then you might want to be putting like 0 to 5%. And as you can see there, as your fees sort of increase, so does the amount of tax that you should be putting aside there. And to translate that into dollars on the next slide, I've just put there. So if you're $500 a week, you only need to put about $25. If you're $1,500, then maybe look to be putting $150 to $200 aside, and so forth. That's kind of the percentages there to give you of what you should be saving to factor in. And look, if you follow that as a guide, you can't go too wrong. But if you just remember and maybe note down 10 to 15% of your total fees, you can't go too wrong. But there's a bit of an indication of what that is. I don't know if I'll just leave that slide on just for a little bit more for people to look at and absorb. I guess the other thing I would just say as people are looking at that, it's important that you start saving consistently and don't delay. It's hard because, cost of living pressures, and you see money there, you want to use it. But it's really important that you continue to save and be consistent with your savings, because it can get extremely difficult if you fall behind. And so I'll move on to the next slide to give you a little bit of an idea of why that is important. And there's an example there, and it's showing that someone who started business in 23 and just like that's their income. And I guess the main thing is that at the end of the day, it works out that they had to pay $3,800 in tax. And basically I'm going to show you a scenario of what it is, what the situation is with that $3,800 if you had saved or if you hadn't have saved. So scenario one is where you didn't save any money. You've lodged your own tax return. So that would mean in November, your tax become like this, and this educator's been going for 1 year. And if they didn't save any tax, so tax estimated is $3,800. So that means they'd have to come up with $3,800 straight away or enter a payment plan. But what the kicker is, so to speak, is that the tax office will start to get you to pay in advance for the 2025 year. So you will have the $3,800 to pay for the year ending 30 June 24, and over the next 7 months up until the 30 June 2025, you're going to have to find another $3,800. So if you haven't saved tax, you have to come up with $7,600 in the next 7 months, which is roughly $1,000 a month that you have to come up with in order to stay on top of your tax. And that's obviously a bit of a hit there. So, and I guess the next scenario is if you had have done the savings. So she started in November and she worked for almost a full year. It was actually 28 weeks. So, and then continued to save until November. So basically 12 months saved $5,000. Now it gets to November, and please tell me if I'm not being unclear here, Matt, because I have jumped around a little bit. But basically, in the example, She started in November 23 and lodged her tax return in November 24. Now, from November 23, she saved $100, which is roughly that roughly about 10%. And therefore, between that 1 year period, saved $5,000. Now, when she lodges her tax return, she'll have to pay the $3,800 because that's from the tax for the last year, and they'll have $1,200 saved there, still in reserve. Now, all that needs to happen then is that they continue to save $100 a week, as they have been the last 12 months, or only $400 a month they have to pay, as opposed to the $1,000 that we went in the last example. And also, you'll save on interest. So basically, by not saving, if we look at the bottom, you have to come up with $270 a week, as opposed to just continuing to $100 a week, which is $170 a week less, plus you save the interest at the ATO. So I guess that the moral of the story is that you have to pay 2 years tax in 1 year if you're not careful. So therefore, the idea is that you do save tax and you're better off. I think that's the moral of the story. And there is savings there. And in her example, there's $170 extra a week they have for the rest of the year. So it just takes that pressure off.
Some really useful information there, Ben, I think. And if anyone isn't quite clear on that, obviously we'll have the episode available to all of our members on our member zone afterwards. And at the end of the session tonight, I'll bring some details up with Ben's contact details at FDC Tax. So definitely reach out to Ben if there's some more clarity required there.
Mm-hmm. Now, I noticed that we've got just some questions.
Yes, so this was
the next section. I noticed there's one about super, and I thought I could cover both of those, like just the next topic, answering those questions as well. Yep, so fantastic. We might just take those.
Yeah, so I guess we'll go on to one of those questions. So there was a question that came in about super. There was actually a couple. One of them was, is it beneficial in the long run to claim your super contributions?
Okay. So with that, basically, if you go to that next slide, there's a maximum that you can put into super, which is 27.5. But when you put money into super, you have to remember that it gets taxed at 15% when you claim a deduction. And just to show you kind of the benefit, so if you were earning more than $45,000, you're paying 32% tax. So if you take the 15% that is paid in the super fund from the 32%, your effective tax savings is only 17%, because you're paying tax. You might be saving 32 cents in the dollar when you pay the tax in, like pay the super into the fund, but when it gets taxed, it brings that tax savings down overall to the 17%. So therefore, look, the higher your income is, the better your savings are. But look, if you are a low income earner, where the value comes in is with the co-contribution. Because if you're a low income earner, if you put $1,000 in, you could potentially get $500 added onto your super account. So look, if you're looking to build up your super and you're a lower income earner, putting at least $1,000 aside is a good thing, because you'll get that $500 a year. It doesn't get taxed. So that's the full $500 that goes in there. So over 10, 20 years, there's look, $5, $10, $15,000 that'll probably add up to. So if you don't need the super deduction, but you want to build it up, that's a good way to do that. Now, if you decide that you want to do more, then you can, but the maximum co-contribution that you'll ever get is $500 on the first $1,000, but you can contribute more. And really, whether you're going to be putting more super in or not is something that's really a financial planner to help you decide as to how much you need to be putting aside. But there's just a small way to kind of build your savings up, because when you're on a lower income earner, the tax saving is not as good. So, but that's a good way to really take advantage of the savings.
Some great information there. And we did have another question on superannuation, but I'm pretty comfortable that what we've spoken about there, Ben, covers that off. So I don't think there's any.
And I'll just mention as well, though, just at the bottom there, I forgot to mention the first Home Saver Super Scheme. That is actually a good, if you're looking to save for your first home, that is a really good beneficial way to get superannuation to work for you. And that's actually a real value add if you're saving for your first home. There is a lot of kind of fine print. It does not suit everyone's circumstance. But if you're looking to buy, say, within the next 5 years, and it's a good way to save that, because not only can you contribute, if you have a partner, they could salary sacrifice extra into super. And there's concession, and it's taxed concessionally. But if you do a search, if you're interested, if you do a search online for First Home Super Saver Scheme, then that'll give you the information in relation to that. And that's where superannuation can really add the most value to you if you're saving for your first home.
Fantastic. I think we did have a couple of other questions, but they're related to GST and being registered for GST. So I think we had a couple of slides, a few slides back. So I'll just take us back to those slides, and I'll actually pop those questions up just now in advance. We can quickly go through them and then let you go through that content. So the first question was, can you please explain being registered for GST and the pros versus cons when you are earning less than $75,000? And the second question we had was, is it compulsory for an educator earning over $75,000 to pay GST? And if so, can it be paid annually?
Yeah. So if you are earning more than $75,000, it is a legal requirement that you register for GST. Depending on your circumstances, you generally can register on an annual basis. There are some circumstances, but really, if you speak to the ATO, because in order to register, you would call the tax office, and that's where you would request to register annually, and they will let you know then if your circumstances meet that there. But it is possible to lodge your BAS statement and claim your GST once a year. Now, in relation to the other question where, the pros and cons. So while you're not required to be registered for, like if your turnover is less than 75,000, you're not required to register for GST, but it can make financial sense to do so. Because if you look at that example, basically, it just goes through what deductions that Sarah has there, and she has $5,500 of deduction, which includes GST of $500. Now on the left, it shows the end result, the total tax and GST savings if you're not registered for GST. So $5,500 is the deduction you would get, because if you're not registered for GST, you can claim the GST you pay as a deduction. So therefore the total expenses would be $5,500, and the tax rate is 19%. So therefore, that tax on that is $1,045. So you'd save $1,045 by not being registered for GST on those expenses. Now, on the right, you have the example if you are registered. Now, you'll see that the deduction there is $5,000. And the reason for that is that you have $500 GST you're entitled to claim. So therefore, you can't claim the GST that you're entitled. So therefore, that's basically the net of GST amount. And that's what the deduction is for. So at 19%, you only get tax saving of $950 because it's a lower amount. But you get the actual GST refund, the full $500 back. So therefore, at the end of the day, you've saved $950, but you've also got an extra $500 back in GST. So that in that example, they've saved an extra $400 in GST, or they're better off by $400 by being registered for GST. Now, you can voluntarily register for GST, and generally I say it makes financial sense for educators to do so. And it normally works out to be more than the $400. Usually it could be closer to $1,000 plus. You're better off overall at the end of the year because you get that full GST back. And that's probably one big area where there is some savings for educators. And the reason why it's particularly good for family daycare is that where you're operating through a scheme and they're a registered service, you don't need to charge GST, but you're still entitled to claim it because it's considered an essential service similar to like doctors and healthcare and some of the fresh foods. It's a special concession that's available for childcare. And so therefore you don't charge GST, but you're still entitled to claim it back. So that's I often get educators say they've spoken to an accountant and they said, oh no, don't worry about it because it's less than 75,000 that you're turning over, but it still does make financial sense to do so. Make sure you understand the like all the pros and cons, because you do need to lodge activity statements and so forth. But like I mentioned before, you can look to do it on an annual basis. So it's not such a burden during the year and having to lodge quarterly activity statements.
Fantastic. Thanks for that, Ben. We'll move on to our next topic. Just move our slides along. So that topic is...
we're talking about getting the most
from your accountant. So getting the best value from your accountant. So
yeah,
interested to hear, Ben, how can people get the best value from people such as yourself?
Okay, so I guess as the slide mentions there, it doesn't just happen at the end of the year to get the best value. The best value is by being prepared and doing the work in the background, recording all your expenses and doing it regularly, because you'll often, I mean, even if you've got a separate business bank account, you might pay for something on your personal credit card, or you might use, your partner might purchase something for you and they've used a different account, and that's not going to show up in your business account. And it's important to record that regularly because you'll remember it at the end of the week, as opposed to 3 months down the track or at the end of the year. If you just keep that consistent bookkeeping through the year is really important. And keeping it up to date, like it mentions there, is that, look, you have all your expense information up to date. So it allows you to speak to your accountant and they can figure out, okay, well, look, this is roughly what your profit is going to be for the year. they can give you an idea of what your tax bill is. And going back to the where we talked about before, income being higher and lower, and using your like spending accordingly. If you have everything up to date, you know roughly what your tax is going to be, and you can get better advice basically by doing that during the year. And just going on to the next slide there. I mean, the other thing is, look, accountants charge on the time taken to complete your return. So therefore, if you are more organised, you're going to get lower or better value for your fees. Because if they don't have to go through all your receipts and everything, they're going to be able to complete it a lot quicker, and therefore it's going to cost you less money. Something I kind of mention later on in one of the other slides that we'll go over is just the fact that you should always speak to your accountant at the time it is due to do your tax return to see if they have any checklists, or if they have like a preferred method for you to provide their information to them. If you ask them up front, and then look, that means you've got it in their kind of system that they're happy with, and it's going to take less time as well. So I guess there's the two things that you do need to prepare for your accountant. One is your income records. And look, you'll have an educator payment history. Those who have been around for a few years, generally most schemes will provide that at the end of the year, to that 1 to 2 page summary showing all your weekly fees, as well as your levies, and just report that. That is usually good enough for your income. And in fact, it's sometimes a bit more accurate than you using your bank statements. The main reason being is that your levies are, like pretty much every scheme, I think I've only heard of one that pays separately, but basically they collect the subsidies and now more from parents as well. They take out their levies and then pay you the balance. And if you're just using your bank deposits, it's not factoring in the levies. And that can affect your GST turnover and stuff like that. So the educator payment history is going to be able to probably be your most accurate income record. But you do need to be careful on the next one. I won't spend too much, but basically I mentioned before, so I just got a bit of an example about double dipping, and just talks about, the parents and the scheme pay $1,000 a week. Now the scheme withholds $100 of those levies, so therefore the $900 is what is paid into your bank account. Now when you're recording it on your tax return, you'd record the full $1,000 and then take the $100 off, so the taxable income is $900. Now what sometimes happens is that educators look at their bank statement and they see, okay, in this example, they would have only received $900 in their bank account. But then they look at their statements and say, hang on, I paid $100 in levies. I'm entitled to a deduction for that, which you are. But if you've only reported $900 in income and then you go and claim those levies again, you've only reported $800 in income, which means you've underdeclared your income and paid less tax. Therefore, you've got potential penalties and interest in the case of an audit. But also in relation to Centrelink, you may get a liability and have to repay. And like, while that example is only talking about 1 week, often levies can be $10,000 or $12,000. And if you're claiming an extra $10,000 or $12,000 over the year, that adds up to a significant amount there. So it's important, because a lot of educators, even to me, say, oh, look, I paid my levies. And I usually just say, yeah, that's right. But where you can't double dip. Otherwise, it's there. And look, there is some tax agents that make that error as well, but it's usually based on educators explaining, not fully understanding what this is here. But just just the next slide, just a little bit of a thing. So less time means lower accounting fees. It's so in organised records, it's more accurate and less risk of overclaiming or missing deductions. And like I mentioned, better decisions as to the timing of purchases it's important. So if you have your records organised in a way that the accountant's happy with it, that's the main thing there. And like diaries as well, if you kept any diaries and logbooks, make sure you have those ready to go as well. But your accountant should be able to help you through that.
Fantastic. Well, we'll go on to our final main topic for the night. And this was a topic that we actually shoehorned into the session at a bit late notice, just purely on the back of the popularity in terms of the questions we received. And that topic is all about what can I claim? So we have quite a few questions to cover on this front. I don't know if Ben, would you like to go through the questions first, or would you like to have a bit of a chat with the viewers?
Yeah, look, I mean, maybe we can just go through the questions there, and we can flick to the slides where those ones are particularly applicable.
Yep. No problem.
Just because I'm mindful of the time.
Yep. We'll go to the first question. So the first question we have here is, next year I need to purchase an 8-seater vehicle to take daycare children with me on school runs. As this will replace our family car, how much can I claim for the car and ongoing costs? It will be used 5 days a week, but we are only purchasing this car to accommodate daycare children. Would we claim the full price and 70 to 80% of ongoing costs?
The amount that you would claim is based upon how much you use, and the way that's determined is via a logbook. You would need to keep a logbook of all your trips for 12 weeks. So that's business and private. And after that 12 weeks, if all your kilometres are for daycare, then you could look to get 100% of that cost, both of the original cost and for the running costs. But if you keep your logbook and let's say it's 80% of the travel is there, then you'd get 80% of the cost and 80% of the running costs moving forward.
Fantastic. The next question we had was from another member. Can I claim building depreciation if an area of the house is used 100% for childcare? And can I claim depreciation of fixtures and furnishings for the area of the house that is used 100% for childcare?
Yeah. So what I'm just going to, maybe if you go down, there's a slide there with just a picture of a house. Just there. So this is the same rules for claiming like improvements that are mentioned there, apply to claiming council rates, building insurance, rent, and so forth. In order to be able to claim the building, like the cost of the building, you do need to have that exclusive area. You mentioned that it is a 100% childcare area. And if you go to the next slide, it talks about this is the criteria the ATO use to determine whether you have an exclusive area. Now, it's some of the most common ones for educators might be a converted garage. Some have an upstairs and downstairs arrangement, or a particular back section of the home. And if you have that sort of setup and those things there, then generally you'll have an exclusive area. Now, what I have put there is actually a bit of a warning, so to speak, in that family daycare is unique in that the kids will use the majority of your home. In most cases, some educators have it set up so they have their home separate, but generally it could be 75 to 80% of your home is used by daycare. Now, just because children use a particular area doesn't make it exclusive. And there's actually a ruling or an income tax guidance there from the ATO where it talks about family daycare specifically, and those tests that are there for exclusive, it says they would not be satisfied in the common daycare giver situation where within limits the children are being cared for or are treated more or less as members of the caregiver's family. So basically, if it's an area that's used by daycare during the day, but then it's your personal living area after hours, you wouldn't get depreciation on that. But if it was and it met those definitions, then yes, you would get a deduction for that there.
Okay, and on to the final question for this topic. It's a bit of a similar theme. We purchased an old property, renovated it, purchased all the resources and started family daycare in the property. We spent almost $100,000 on this. Are we entitled to any refund in tax?
Okay, so assuming that is what those renovations were for, an exclusive area, then yes, you would be entitled to a deduction, but it would be claimed by depreciation at 2.5% a year. So you would so that's on 100,000. So you would get a deduction of $2,500 every year. That wouldn't be, you wouldn't receive $2,500 back. It would just be the savings on that $2,500. So using the example of the 30% tax rate, 30% of $2,500 is $750. So therefore, on that $2,500, you'd save $750 in tax, or on the full 100,000, you would end up saving, assuming your tax rate is 30%, you'd save $30,000 in tax on that 100,000 over up to 40 years. So it unfortunately, because it's a permanent structure, it's depreciated over the life, which they say is about 40 years with your home.
Great, thanks, Ben. Well, I guess that brings us to the main end of our main topics. We do have a few more questions to cover in our final Q&A section. And just mindful of time, we have a little bit of time left, so we'll see how we go with these last couple of questions. If we're lucky, we might be able to squeeze another one or two in, but we'll just see how we go for time.
Yep.
The first question of those is about capital gains tax. How long do I need to not claim interest on my mortgage before I'm cleared of capital gains tax requirements? Is there any way around this, and what are the rules for family daycare educators?
Okay. Look, if you are entitled to claim your mortgage interest, your home does become partially in accordance with that exclusive area. So basically, if you have one room and it's 20% of your home, then 20% of your home will become subject to capital gains. Now, and it's for the period that you use it. So let's say you use it for 5 years for family daycare, and then you don't do anything for 10 years at your private home. The calculation would factor in 5 of the 15 years. So you'd work out 20% of the gain, and then 1/3 of that would be still assessable because you used it for 5 years out of the 15-year ownership period.
Fantastic. And one final pre-submitted question. I'm considering doing family daycare from my main residence. If in the future I decide to sell my home, will my main residence be subject to capital gains tax from my family daycare activities?
Okay. Just because you're using your home for daycare doesn't mean that it will automatically become subject to capital gains. Really, the deciding factor is that exclusive area. If you have that exclusive area and you're entitled to claim those deductions, then it does become subject to capital gains. But what I usually say is that, look, sometimes it is a very grey area. And if you want to argue that you don't have a separate area, the ATO is generally not going to argue with you. And you can probably, by not saying you're not entitled to claim those, you can probably not have to worry about that. And if you don't have any exclusive area at all, capital gains is not even an issue.
Great. Well, I can see we've got just over a minute left, so we try and squeeze one or two quick questions in. We've got one that's come in from Chelsea, just recapping back on some of the content we covered before. And she was just wondering, Ben, if you can claim parent levies as part of your taxable income.
Yes, so basically those parent levies that are paid if it's an expense that you're having to pay the scheme, then yes, you will get it as a deduction. It's just the way that it's reported in your tax return, like I went over before.
Fantastic. And I guess one quick final one that I can see here. Danielle had asked about claiming hours worked doing, I guess, preparation work for the family daycare.
Yep. You would be able to include that as well. You just need to have a record of that. And a diary of what you used, and you can get those hours as well.
Fantastic. Well, I think that pretty much wraps us up for the night. As I said earlier on, the episode will be available on our member zone for all of our members to view at their convenience. Really big thanks to Ben for coming on tonight, giving up his time. If anyone would like to reach out to Ben or FDC Tax, you can definitely do so via the details on the screen that you can see below. And we'd just like to really thank everyone for watching tonight. A big thank you to everyone who sent their questions in. Is there anything that you would like to add to finish with, Ben?
No, just thank you everybody for coming. I hope it's been of assistance to everybody. And have a lovely evening. And we're here if anybody has any questions.
Wonderful. Well, thank you everyone again for joining us tonight. Our next webinar will see us return to our normal FDCA online engagement series content. And our next session will explore the role of the educational leader. This episode will take place on Thursday, the 25th of July at 12:30 p.m. But until then, thank you again, and we will see everyone on July 25th. Thank you.
Okay. See you, everybody.